Jason Butler from Bloomsbury Wealth. You're a practitioner, you write about, you speak about wealth management, investing. You've written the Financial Times Guide to Wealth Management, and you've just spoke at our BPR Masterclass. Thank you very much for contributing today. What's your overall opinion of BPR? I'm interested in where you think it fits into the big picture of estate planning and how you go about fitting it in with a client's plan.
Well, BPR in the sense of a product that's not someone's trading company. Business property relief that gives you exemption from inheritance tax really fits in that space where clients have potentially got an inheritance tax problem and either can't give the money away because they may need it, or increasingly with the clients I work with, they don't really want to give it away. It's more of an emotional decision. So I see BPR as that relatively non-aggressive halfway house between keeping all your money and doing clever giving it away planning. And I think in combination with other planning, you know, the normal exemptions and reliefs and small gifts and surplus income and so on, and together with perhaps trust-based gifts or paying for school fees, it does have a part to play. Particularly for me, it's the client who has realised business investments and is at a stage in their life where either can't or don't want to re-engage in their own business investments and want to preserve for a time being the inheritance tax exemption from what they used to have in their business. And that also opens other opportunities for them to make larger gifts to trust with those assets. It enables them to, for instance, think differently about their investment strategy, because some BPR-based investments have a different investment profile, may not be as racy as one thinks they are, but they may be more steady. They may be completely non-correlated with the client's normal portfolio. Or it may be that what they've decided to do is hold it as a holding place until they actually do find the business that they want to run themselves. So it could be a holding pattern. So I think the market that I'm in is with people who either can't give that last bit away because it may well affect their latter financial security when they're in the third age, for instance, very expensive care fees, perhaps 120,000 a year, or live-in care, or they just don't want to for emotion, and they just can't give themselves that okay to give the money away. And in fact, they probably want to control the money once they're dead, but that's probably a bit tricky.
And when you're looking at the range of BPR products out there, what sort of criteria are you using to choose those products and select the product providers?
Depends what other planning the client's done, whether they have existing EIS type investments, whether they've got matured EIS investments, whether they've got other unquoted investments in other businesses. But essentially what you're looking for is that the provider who's putting together this BPR-based investment has got a track record, has got the resources and the capacity to do the research, has got the scale, and this is really important to access some of the opportunities that are out there. And here's the other thing, it's got a commitment to innovation, so if they do need to adapt their offering, the structure, or adapt to new rules, or there are activities that are outlawed as not qualifying, that they've got that flexibility to adapt. And most of the big providers have got that. Some providers focus on different areas. So for instance, some are focused on AIM, others have nothing to do with AIM. Some do what's called a multi-silo, multi-trade approach, whereas others are specifically, say, in renewables or infrastructure. So I think and this is where the research services, there are 3 or 4 independent research services that actually do the drilling in, but it's no substitute for your own firm deciding what your view of the world is with BPR type products, what you do not want to consider, and then sort of getting yourself down to a short list of the types of solutions and from the providers that you want, and what kind of client situations are they appropriate for. So for instance, a mum and dad affluent client who wants to put 100,000 in as a halfway house into a BPR type investment, there may be a slightly different offering to the serious entrepreneur who wants to park his £15 million realisation from his business for 2 or 3 years. And who may have a deeper capacity to understand the investment fundamentals. And a number of the providers enable you to mix and match, several trades or one trade. Some have lower risk profile but lower upside, some have higher upside and more of a risk. So, but whatever happens, when you get to that shortlist, then you really do need, if you've got 2 or 3 providers, you need to go to those providers and ask them what they're prepared to do to trim their charges. And that's all about, do you want the business? how big is the investment, and what are other people offering. And you'll be surprised, they all will trim their initial charges, particularly for large cases. Some of them will do something on the annual, but always ask, because what you don't ask for, you don't get.
I think that's good advice for advisors themselves. It is, as you said in the presentation, one of their responsibilities. An investment maxim is also, don't let the tax tail wag the investment dog, but obviously this is all about mitigating a particular tax. Does that maxim still stand when investing in BPR?
All advisors will have their own view on this. My personal view is do not lose my client any money. Now, some provide a straight line of 3% and they keep all the upsides. Other providers give you the upside, 7-8%. And some of them have been a disaster and they've lost their clients 10 or 15%. I think if you can just preserve the client's money, even if it's being eroded by inflation, if the cap fits where, if the inheritance tax benefits are so important to that client and they can't or won't give the money away or do other planning, then I think a client who hasn't made money is going to be less unhappy than a client who has lost 10 or 15% of his money. Because don't forget, inheritance tax is only payable when you die, so it's someone else's problem. It's a nice to sort of a bolt-on. It's nice to make money on your BPR investment, but I think if you can just temper the client's expectation to, look, there's a good chance, hopefully, finger in the right, cross our fingers and hope it goes the right way, that we'll at least get our money back. You might make some money, but what you're really doing is you're trying to access that inheritance tax. So in answer to the question, you do not want to let the tax tail wag the investment dog. We have to be realistic. The BPR market exists to meet a need. If you want the highest investment return, you've either got to invest in something extremely speculative, particularly say your own business or property development or something very concentrated, or you've got to invest in the market portfolio, a diversified portfolio, and accept it's in your estate. Or you've got to hold it in cash or very, very low volatile assets, in which case the long-term return is probably going to be less than inflation. So I'm not really sure that without BPR people will be rushing out to buy these investments. But my personal view is if you can temper the client's expectation, if you can match their expectation for no return, but hopefully, very low chance of loss, together with the inheritance tax benefits and other planning they may do with those investments, I think you probably are going to have a client who's going to be very happy. And expectations and perception are all that really matters after the event.
Yes, yeah, that makes perfect sense. One more question. You touched on it in your presentation and it came up in the Q&A, and we talked about, can providers innovate? If we see a change in the legislation or the rules around BPR, what's your sense on that? Do you think we'll see a change?
Well, I think the three potential changes that could happen is, yes, restricting it to only owner-controlled businesses, so closely held businesses where you own all the share capital controlling it, or changing the underlying trades that qualify, okay, or changing the exemption from 100% to perhaps 60, 50, 30 or 40, or even a time-based exemption, and increasing the holding period perhaps to 7 years. So there are several risks, but I think it's like anything. The financial services sector in the UK is one of the most vibrant, one of the most incredibly dynamic, and one of the most incredibly innovative in the world. And I think if there's a possibility, we can only plan with what we know today. I think you'd wait till the election gets out of the way and we get the emergency budget before you do any substantive planning. I think that's fair to say. But I think by the time you're reading or listening to this presentation, that will have been done and gone. I think you just have to make sure you choose providers that have got that scale and commitment. And they will adapt and they will change, which is why you've got to avoid massive upfront setup costs. And avoid exit penalties, because if you do need to unravel stuff, that's the beauty of BPR, assuming you can cash your investment in and assuming you're not paying a fortune for getting into it, then you can adapt. And if things do change, I think the good providers will be able to perhaps segment off individual companies, but it will mean perhaps the investment minimums go up and perhaps they have to change some of their trades.
Yeah, so access and liquidity is one of their big selling points. So you need to make sure that that is genuine access and genuine liquidity in case they do need to innovate in the future.
Well, one thing's for sure, the rules won't be the same in 10 years than they are now. So you plan with what you know today with an eye on the future, and then expect it to change. And if it doesn't, then that's great.
Jason, thank you very much for your presentation today. Thank you very much for the interview, and hopefully we'll see you at another event soon.
Great, look forward to it. Thank you.